So we move into Chapter 9, Partnerships, Part 1. Two parts to this particular chapter. And indeed, we have an idea on partnerships, believe it or not, because as we'll see, partnerships follow on nicely from our knowledge of unincorporated traders. Let me explain what I mean. In terms of a partnership introduction, it's really a group of people carrying on a business together with a view to profit. In effect, it's a single trading entity. But in terms of them being a partner in this single trading entity, they are still separate taxable persons for income tax and for CGT. So in effect, as we'll see from the final paragraph, they're assessed to tax really as sole traders, as individuals. So if you will, we can see this chapter, although it's entitled Partnerships, as really rules that build on the sole tradership rules, because at the end of the day, once we've allocated profits to a given partner, then in effect, they're treated in the same way as we saw previously in terms of base of assessment, etc. So that's the introduction. In terms of allocating trading profits and losses, what do? Well, if we have a series of people working within a single entity, in effect, what we're talking about is a set of sole traders who must have some form of partnership agreement where they agree to, if you will, the partnership split of profits. On a simple basis, it might be two partners, 50-50. So in essence, these partnership profits and losses, they're determined for a period of, as a whole. They're clearly adjusted, as you would have thought, for tax purposes in the same way as a sole trader, and then allocated between the partners in terms of the profit sharing agreement. So in essence, you'll have, let's say, two partners. Once we've gone through the motions of adjusting the accounting profit and making it a tax adjusted profit, then basically we just split it. So in terms of these profit sharing arrangements, this will be laid out in the partnership agreement, which is in effect the sort of birthing document of this particular business, of this particular partnership. It will also talk about partners' salaries, interest on contributions to the firm's capital, and obviously the profit sharing ratio. Now let's not get confused. When we think about partners' salaries, we're not talking about salaries in the ordinary sense of the word, as if an employed individual will have a salary. We're actually talking about really a draw. So in other words, in line with the profits that the company is making, the partners will probably have some sort of agreement. Well, each month, let's say, regardless of profit, we're going to be drawing out £5,000 a month. That's the salary. The interest on contributions is just that. Each partner will probably make different contributions, injections of funds into the firm, and they may well receive interest on those injections. Okay, so there's several forms in effect of remuneration, as it were, but the bottom line is that everything stems from the profit. Now, in terms of salaries and interest, technically they're not deductible expenses. They're just draws. They're merely an allocation of profit. So really, it's therefore the balance of profit after allocated salaries and interest on contributions to capital that is distributed in line with the profit sharing ratio. In effect, each partner has a sort of a minimum level that they'll get. Okay, you'll get your salary, you'll get your interest, and then after that, we'll split up the remaining profit. Moving from there, in terms of areas that make things a little bit more complex, certainly changes to the profit sharing ratio can cause issues. Let's think about it. If we have a given year, we've got two partners, it's a 50-50 split, great. Let's allocate salaries, interest on contributions, and the balance 50-50. But if the arrangement changes during a period of account, then clearly we need to time apportion the periods before and after the change. Imagine, 6 months through the year, they decide to change it to 60/40 for some reason. Obviously, the amount that will be assessable on each partner then changes. In terms of how we do it, clearly before the change we have the old arrangement, after the change we have the new arrangement. Okay? Now that area there does become relevant a little bit further down this particular mind map in terms of admission of new partners, partners retiring, etc., etc. More of that in a moment. In terms of capital allowances, let's note that if the asset is owned by the partnership or by one of the partners, might be a building perhaps that they operate from, the capital allowance is just calculated in the normal way for the period of account as normal and deducted as a trading expense. So just because an asset is owned, let's say, by a partner, doesn't make any difference. Capital allowances, again, as we saw previously. Moving from there, this area of admitting partners or the retirement of partners is one that impacts upon things considerably. So let's talk about a new partner arriving. So we have, let's say, a partnership with two individuals, 50-50 split, and we have a third partner. So if we have a new partner admitted to the partnership, or even let's say a partner retires, there's going to be a change. There has to be a change in the profit sharing arrangement. So in essence, when a new partner is admitted to an existing firm, the incoming partner note is assessed as if they are newly self-employed sole trader on the basis of the share of the firm's profit. Let me explain that further. We've said that partners are really a set of sole traders. In essence, we go through the motions of tax-adjusted trading profit, we allocate salaries, interest on contribution, and then we tax them as sole traders. So if we have an incoming partner, they're a sole trader too, and we use the opening year rules for this individual. Moving from there, in terms of retirement of partners, again, as you would expect, a partner leaving the firm, the last year basis applies to their share profits only. Assessment basis for the remaining partners is unaffected. Moving from there, in terms of the firm, let's just say that the partnership ceases, okay? Then really the last year basis applies to all partners. In effect, you go really from the last day back to the previous 5th of April, okay? So, in terms of this part 1, what have we learned? Well, nothing much more than what we already knew, except for this whole area of the term profit sharing ratio, and indeed arrangements with regard to salaries, and indeed interest on contributions. So again, like other areas of the TX syllabus, if we get into the questions, we'll see this manifest itself more clearly. I would say that certainly I'd favour sole traderships and capital allowances as questions over partnerships questions. They do appear, but perhaps not as often as questions relating to sole traders. Okay, I hope that helped and that your studies are going well. Thanks for listening.